Okay. So questions? Nobody has any questions? Okay. Let me do something here actually that might be beneficial. Let's do this video that I watched recently. That's really, I think, a great video to watch about the economy, how the economy works. It's about, looks like it's 31 minutes long. Um, okay. This is the link for the video. Everybody grab that link. And when you get a chance, watch that video. It's a really good video just about the understanding of cycles, the short-term, long-term debt cycles and productivity. It's a really good video to give you an understanding of the ups and downs and some of the strategies that are used to help the market when it's struggling, to help the economy. Talks about credit and how credit works. Talks about incomes versus what you spend is another person's income. Really good stuff. It's a good video to watch. So it's only 30 minutes long, and it's got some good content. If you are interested, we can talk about that video next week on the call. We'll just discuss any questions that you have. But it's definitely a video worth watching. Okay. Is there a way to get fund transfers faster than 4 days in the usually it takes 3 days to settle. When your trades get settled in 3 days, so no, I don't think you can get your money back faster than that. Not if you're trading stock. You're trading forex. You're trading, other types of instruments. You might, but if you're trading, actual stock market options and stocks, you're going to have to wait a few days to get your money. Does that answer your question, Frank? Because it takes 3 days for them to settle a trade. A lot of it's virtual, right? But the trade has to be logged and the money has to be moved from one place to another, and then you get your money. But when you're trading it in real time, you don't have to worry about that. Any other questions from anybody? Okay. No questions about the market or what's going on? The market's been definitely moving quite rapidly. Now I trade the U.S. market. I don't trade the Canadian market. The major Canadian markets, Canadian stocks are on the U.S. stock exchange, like the banks and stuff. So you'll see a lot of them on both markets. But I trade the U.S. market because it's just more liquid. And liquid just means there's more money going in and out of that market, allowing you to get in and out of trades, right? Easier. It's the most liquid market in the world. So definitely my choice is the U.S. market. So I trade the U.S. market. Frank, you don't have to pay for real time if you do so many trades. If you're an active trader, you got to trade so many times. I don't know what the number is, I forget. But if you trade so many times a month, you don't have to pay for it. If you're an active trader, you don't have to pay for it. If we max out our TFSA and RSP, would you still recommend exceeding the limit and invest now when it's low? Well, we don't know how low is. So, if you max out your RSP and you max out your TFSA, you're basically trading your own money. It's going to get taxed regularly. So, I don't know exactly the benefits that you get out of over contributing. Other than if you want to use that capital for investing, that's great. But you definitely need to know this is not a place I would suggest trying out in the market. You can get, hurt pretty bad. You can get lucky too. I mean, the market. I mean, you could buy a stock. Example. I'll give you an example. So the cruise lines have been just killed. They've just been destroyed. So a lot of people think, well, the stock has gone from 90 to 20. Why don't I buy some of the stock? And I think that you could do that, and some of those stocks have doubled in value. But if you're looking for the company or the survival of these cruise ships in long term, that's going to be a problem. It'll be a serious problem, as these companies are going to take quite a while to come back on their feet, as many companies are, but them in particular, it's going to be tough for them to recover. And I'm sure at some point down the road they will. We'll have to see. I'm sure they're going to be super aggressive in trying to get people back on ships and marketing. So we'll see what happens. But if you're looking for easy money, I'd say this is not the place in the market to try that. If you're looking for dividends, again, very difficult because none of these companies are going to produce anything serious in the next 2 quarters, for the most part. So that's a problem. If you're trading now, you're trading for, you could start building positions, I guess, for long-term investing for some of these companies. But for me, I'm not a trader that trades for companies. I'm trading for the movement to make money. So, this kind of movement for me is great. I love it. It's very profitable because of the movement. There's huge opportunity. So to do that, though, you have to trade manage, and you have to be on top of your trades, because a trade that can be profitable can go into a loser, and losers can become profitable if you're given enough time. A lot of people have a challenge knowing when to get in and out of trades, so that's something that you definitely have to know how to do consistently if you want to make money. Otherwise, you can really get hurt in a market like this. So this is why I would say that you could pay, instead of throwing it in there, the money into your registered accounts. You could just use the money to invest with, right? It's your money, but you're paying taxes on that money. So that's the thing. You have to measure it, right? If you think that you're going to do better off over contributing, then knock yourself out. If you think that you can take that money and make money somewhere, and to turn it into something, I think you should. I think that it always comes down to the numbers, right? It always comes down to the numbers. Abdel, is that good? You understand where I'm coming from? It's a question of, do I have a better place to put that money? So why don't we do this? Why don't we look at the S&P 500? Let's see. Okay, so I'll share my screen. So what I'm going to show you is a chart of the market, S&P 500. There we go. Okay, everybody see that okay? Okay, so this is a chart of the market. This is the last few days. This is a daily chart. You've seen that the market was way up here, came down, broke down, and the last 2 days, we had a huge rally yesterday, biggest rally since 1933, huge rally. And then today it tried to get up, came back down near the end of the market, it chased it down. We'll have to see what happens. You can't hear? Can you guys hear me okay? Yeah? Oh, okay. Give me 1 second here. Let me switch something. Oh, that's the right one. Okay, we're good. Okay. So, screen, hold on. So just does everybody understand what the S&P 500 is? Does anybody have any questions about the S&P 500? What it is? It's the 500 biggest, or supposed to be healthiest companies, best and healthiest companies in the market. It's used as a overall indicator of what the market's doing and where it's going. Um, so it's not the Dow. The Dow is a different series of companies. So you know the S&P, because it's a wider range of stocks, is used as the primary to tell us what the market's doing. So these lines here, actually, I put on a few weeks ago to talk about, way back here, we were here. We talked about, the market possibly going down to this level, down here, and even down to this level, which is way back here, right? This is 2018 low. It went below that. There's another low. If you go to the weekly, if you go down lower, we don't know how low it could go. Nobody knows that really. But the money that they're pouring into the market is definitely, the government's pouring in. Canadian government too is the idea behind it is to stimulate the market. That's what they're hoping. They're hoping the market, does, recovers. To do that, you can see it can drop down to even here for support, the next support line. So that's hitting the market, 50% drop from where the market was at the high. That's down here somewhere. We don't know if the market's going to do that. I would believe that the market's going to, it's not done, getting stable. So we could see the market go down again, go lower. Nobody really knows. But the money that they're putting in is giving Canadians, giving Americans. The idea is to get people to spend because the consumer is such a big part of the economy. Now in Canada, consumer is a big part of our economy, but we have natural resources too. That's why the drop in oil prices was really harsh and hurt Canada. Canadian dollar was hurt because of that. So all this being said, what do you do as an investor? How do you take advantage of this movement or opportunities in the market? And what I want to share with you is, what I do, how I approach the market, and from what place I do. And the place that I approach the market is through the use of options. So what I'm going to do is I'm going to talk and start introducing options to you, and how they work. So, any questions? We're good? All right, so you probably, I'll tell you what you need to write down. We'll go through this slowly, and whatever we get done by in the next 15 minutes, don't worry about it. We'll just continue doing it week to week, okay? So option contracts, you have the right to buy 100 shares of a stock at $50 on or before May 31st. So an option has really three components that we're going to talk about. So we're going to talk about what does this all mean, right? What do options mean? So we have, what are option specs, strike prices, and the delta rule. We use rules to trade. I'll talk about them. Expiration and theta rule. The delta and theta, these are called Greeks. We'll talk more about that, but they're what we use to create probability. Delta's for probability, and theta is for time. That tells us about time and the value of time. Option price, obviously the cost of getting an option contract, that's also something that's important. So what is an option? You should write this down. Contract between a buyer and a seller that gives the purchaser of the option the right but not the obligation to buy, sell a specific stock at a specific price on or before a specific date. So very similar to an option to purchase contract with real estate, right? When we put a offer to purchase contract, it's an option contract. We have the right but not the obligation to buy. So if the conditions are not met in the contract, we don't have to buy. But we have the right to buy. No one can stop us from buying the house. So we have the right to buy or sell. when it comes to stock, but think of the buy side first for now. A specific stock at a specific price. So when you offer to purchase on a house, you get to offer, say, 300,000 for 30 days, and you put down a deposit of $1,000. That would be the same thing as an option in real estate. In the stock market. So we have the right to buy this house for 300,000 for 30 days, but we don't have to buy it, right? If you don't meet your conditions, we don't have to buy it. Well, it's the same thing with these option contracts. If the condition is not met, where you're making money, you're profitable, you're not forced to exercise the option. Make the contract come to fruition. So, and very similar to the closing date of 30 days, we can do that anytime during whatever period of time that we have. I'm just using the example of a real estate contract. Okay. So key terms: the strike price, the price the buyer has the right to purchase the underlying asset. So, when we're looking at that, we're talking about, strike price would be a stock is trading at $10. I decide to buy an option at $15. That's the strike price. That's the price that I get to buy the stock at, $15. Does everybody understand that? That makes sense? Tough when you're not here, but that's basically what that means, right? So let's say the strike price is $15, okay? So the ABC stock, okay, is trading at $10, okay? Trading at $10. I decide I want to buy a contract that allows me to buy the stock at $15. That's the strike price, $15. Make sense? Yes? Okay, good. So then we have expiration, the last day the contract owner can exercise the right. So let's say that I say I'm going to buy the strike price at 15, right? I want to have the right to buy the stock for $15, and I want that contract to be open for 30 days. So 30 days, I want to be able to do that anytime during the 30-day period. Okay, does that make sense? That's expiration. Okay, so 15 is the strike. Expiration means anytime during the 30-day period, I'm allowed to buy this stock for $15. Okay, it's trading right now at 10. Okay, then we have underlying asset upon which the contract is based. Well, what's the underlying asset this contract is based? It's based on, of course, ABC stock, right? ABC stock is the underlying asset. Okay, ABC stock is the underlying asset. Okay, so I have ABC stock, the underlying asset. The expiration is 30 days. I can do anything I want during this 30 days at this strike price of $15. Okay, I can buy the stock. If it's a call option, we'll talk about calls and put options, then that's what it allows me to do. Okay, premium is the cost or value of the contract. So I want to buy the right to buy this stock at $15 for 30 days of ABC stock, and the cost to me, you have to pay for that, right? Because no one can take that right away from me. So let's say it's $1. Okay, it's $1. That's the option premium. Okay, it makes sense. $1 is the option premium. So for $1, I'm allowed to buy ABC stock anytime during the next 30 days at this price of $15. Make sense? Okay, good. All right. So, did anybody need more time with that slide? We good? Okay. So call options are the right to buy the stock at a set price by a set date. Okay, that is a call option. Okay, does that make sense? So there's different types of options. So we were talking about ABC stock. So ABC stock, we had the right to buy the stock at $15. That was our strike price, right? And the set date was 30 days. Okay, and let me just do something here. Hold on. Erase. Okay, let's do this. Hold on one second. I'm just going to put them in different places. So I have the right, do that again, I have the right to buy A, B, C stock. That's the right to buy it at a set price of $15 for 30 days. Okay, so this is $15. Okay, and I can do that for 30 days. Okay, that's a D. Okay, so ABC stock's the underlying instrument. Okay, so if the stock ABC is trading at $10, okay, it's trading at $10, okay, that's what it's trading at. What do I want the stock to do? If I have the right to buy it at 15, and right now it's at 10, what do I want the stock to do? Well, I want the stock to go up. I want it to go past 15. Okay? So when you buy a call option, you're saying I have the right but not the obligation to buy ABC stock for $15 anytime during these 30 days. So what do I want the stock to do? Well, it's at $10. I want it to go to $30. That's what I want. The put option, on the other hand, is the opposite. So the right to sell a stock at a set price by a set date. So this would look like, let's say, again, okay, we're going to use ABC stock. Same concept. So ABC stock, okay? So I have ABC stock, okay? I get the right to sell it for, say, $8. Let's do $8, right? So I get to sell it at for $8. Okay, so that's a set price. I made that a little lower. Let's see. Let's erase that. So ABC stock. I'm going to have the right to sell this stock. Sell the stock at, let's do that, $8. So the set price is $8. Okay. Okay. And also 30 days. Okay. This is a different contract. Okay. So if I'm doing ABC stock and I want to have the right to sell it for $8, what do I want, the stock to do? I want it to go down, right? I want it to go down. Okay. So when you buy a put option, you want the stock to go down. When you buy a call option, you'd like the stock to go up. Simplifying, right? And sell it at a higher price. You mean the put option? So put option, actually, I want it to go lower because I'm allowed to sell it to someone for $8. So if it's at $10 and it goes to $5, I get to sell it to you at $8. Does that make sense to everybody? Anybody confused about that? Does that make sense? It's okay if you're confused. You should tell me. So when you're dealing with options, you can either look at a stock going down or a stock going up and taking benefit from that, because obviously stocks do both. Okay, so the terms of the deal, right, of that contract, we have a time component. We talked about that. We have a price component, the cost, and then the deal. That's the strike price, right? So we got to have the right combination of these when we're dealing with options, right? When we're dealing with the underlying stock of a company, ABC stock, right? So ABC is trading at 10 or 20 or 30, it doesn't really matter. What matters is how much time do we need to be right? What's good value for a price? And what do I get to do when I get this contract? What's it allowing me to do? Okay. So when you're trading options, this is very important. So when you buy a call, you make money if it goes up, you lose money if it goes down, and you lose money if nothing happens. Does that make sense to everybody? Okay. All right. So on the other side, if I buy a put, right? That means if I buy a put, if the stock does nothing, I lose money. If the stock goes up, I lose money. If the stock goes down, I make money. Okay? Does that make sense to everybody? So I know it doesn't to people who are new to this kind of stuff. So what I'm going to do is I'm going to stop sharing for a second. I'm going to explain that. Okay? So as an example, so we have A, B, C stock at $10 again. Well, let's make ABC stock $30, okay? So our numbers look a little bit easier to look at. So $30 is the actual price of the stock, $30, okay? So if I buy a call option, okay, with a strike price of 35, so I get to buy it anytime for $35 for 30 days, okay, days, and it costs me $1, okay, to buy that right, okay? So if this stock, ABC, stays at $30, okay, stays at $30, I lose $1. Does that make sense? Because it didn't get to 35. I only want to buy it when it gets above 35. Does that make sense to everybody? Right? Why would I buy the stock if it's at 30? If it was at 32, 33, 34, why would I buy it for 35 when I can just go buy it at 34? So I'm guessing, right, or speculating that the market's going to go up. The ABC stock's going to go up. So I would love if the stock went to 40. If the stock goes to 40, then I make money, So going back to ABC stock, oops. Hold on. Let's go back. It's right there. Let's see. Okay, good. So ABC stock. Let's see. Okay. So ABC stock. So it's at 30. It's at $30. Okay. If it goes to 35, sorry, goes to 40. Okay. If it goes to 30, or it goes down to 25. Okay, that's what we're looking at. Okay, it's $25, $30, $40. Okay, so I have the right to buy it at 40. Okay, I have the right to buy the stock at 35 anytime I want. So the option allows me to buy anytime I want for 30 days at $35. Okay, so if the stock goes up, up to 40, how much do I make? Well, if this cost me $1, okay, it cost me $1 for this contract for 30 days, right? I can do that, okay? Then I made $5 on the stock. Let's go back to that. $5 on the stock. So I make $5 on the stock minus $1 that I paid for it. So I make $4. Does that make sense to everybody? I paid $1 for it. I make $4. Okay? All right. If the stock goes to 30, then I'm not going to exercise my option. Right? I'm not going to actually say I want to buy it at 35 because it stays at $30. Anything under 35 is no good to me. So if it's 30, it started at 30 and it goes to 30 or under 35 really for us, right? Then what happens here? Well, I made $0 and I had to pay $1, so I'm down $1. Okay, make sense? Okay, so if it goes up, I've made $4. If it stays straight, under 35, I lose $1. Okay, if the stock goes down, okay, again, it's no value to me. This option has no value. 30 days have passed. It's coming on 30 days, right? Because it's only good for 30 days. 30 days have gone up. So what did I make on the stock? I made $0 on the stock. I had to pay $1. So I'm down $1. Okay? This is a call option. If you buy a call option, as you can see, you only make money when the stock goes up. You do not make money when the stock goes down or goes sideways. Can I get a yes from everybody that you understand that? Okay. Good. So it has to be higher than 35 in order to make your money, correct? If it's only 34, you still lose money. That's right, Henry. Can I get a yes from everybody, please? Everybody on the call, tell me. If you don't understand, folks, it's okay. You can tell me. You should tell me that you don't understand. So that's Rodrigo, good. Let's see here. What am I missing? So you said yes. Frank's good. Andrew's good. John's good. Good. Vincent. Break even is 36. That's right. Okay. So it follows, and I'm going to wrap up with this last example. Okay. Quick question. The button close to the will exercise the call option, right? Quick question, Sam. The button close and IB will exercise the call option, right? No. If you close the position, you're just, if you bought it, you're just selling it. That's all close means. If you sold it, then you're buying it. That doesn't mean you're exercising it. It means you're closing the position. Does that make sense? Frank? If you close the position, okay, well, let me explain. And then we'll wrap up for tonight, okay? So let's say 15 days go by, Frank, okay? This is for everybody, really. So let's say, again, I'm ABC stock. It's at $30 is the stock, and I have the right to buy it at 35 for 30 days, and it costs me $1. Okay. So if the stock tomorrow goes to $38, okay, $38. If I close the position, what's going to happen? Well, this option contract is no longer worth $1. It's probably worth $3.30. Okay, $3.30. Okay, that's what it's worth now. Okay, so when this moves up to 38, this option contract value is going to go up to say $3.30. Okay. So Frank, if you hit close, what it's going to do is you bought the option for $1. You're going to sell it for $3.30. So you're going to be a credit of how much? $2.30 is what you made. Okay? Does that make sense? Okay. So you made $2.30. My apologies. You're going to get your $1 back. So it's actually you made $2.30, but you're going to get $3.30. Does that make sense? Everybody understand? You paid $1, you're going to get $3.30. That's not all your money, obviously. You made $2.30, but you do get your $1 back. Okay? You do get your $1 back. Does that make sense to everybody? So we're going to stop here. I'm going to answer last question, okay? Because I need to get ready for the next call. Any questions about what I explained? I'm going to go through every single one of these option setups. And we can look at them, and then we'll go to real stocks, and we'll look at them. Okay, so let's see. Now I just set the option to buy, not to sell. If I did not set up the option to buy, then sell. Now I just set up the option to buy, not to sell. I don't know what you mean by that, Frank. If you bought the option, if you're setting up to buy an option, so my expectation is to keep the stock. If you want to keep the stock, yeah, you can keep the stock. You can keep the stock, absolutely. So if you buy the call option, Frank, and you don't exercise it before, if you don't do anything or sell it before the 30 days, can you hear me? Folks, can you hear me? Yeah, I don't know what's going on. Frank, can you hear me? No sound, Frank. That is weird. I'm sure it's going to come back right now, right? Now working. Okay, no worries. Okay, so Frank, you can take this stock away from the person anytime you want. So instead of selling the option, you can call away the stock. You can say, I want that stock now. And they have to give it to you. Does that make sense? So yeah, you have the stock now. You have the stock now. The contract's closed. And they would be okay with that. They'd be okay with that. I mean, if you want it, you can take it. You gave them $1. They're going to give you the stock for 38. They lost $2. So if you want to keep the stock, don't exercise the option. Sorry, don't sell the option. Does that make sense to everybody? You can ask for that stock anytime you want. They'll give it to you, and it won't cost you anything other than the $1 you pay. But you still have to give them that $1. That $1 is theirs. You paid $1 for it. You don't get the $1 back, but you get the stock at 38. I have a red button that says close position. Next, there is a reverse position and view account. So reverse position means instead of buying it, you sell it. That's what that means. So my idea is just to close the position and then get the stock. You don't have to, no, you don't close the position. If you close the position, you're doing this. You're selling the stock. You're selling the option. You're not getting the stock. You have to exercise. You're talking about after the 30 days. No, Rodrigo, you can do this anytime you want. You could do it the minute you buy it. You could do it. You can do it anytime you want. You can call away the stock anytime you want. That's why it's called a call option. You can call away the stock anytime you want. Okay, once you buy the contract, you can do it anytime you want during that 30-day period. There should be an exercise button, Frank. To exercise the stock. So Frank, if you want, yeah, you can go to the help and see that, or you can Google actually IB exercise option, and it'll explain it to you. Okay. Any questions before we wrap up? We're running a little bit late. That's okay. We good? All right, everybody. That's our session for this week. Please only use paper trading unless you're an experienced trader. Please, again, paper trading only. This is going to be a process, but we got time. We're all at home now, right? So we got time. Let's just take it a week at a time. And for now, we're still going to go once a week. I might go to 2 a week. We'll see what happens. I said that I would see if I can make that happen. But I have another class that I'm dealing with right now, and I need to integrate them in the stock real estate class. I'm seeing them this week. So next week, we'll talk about possibly going to 2 weeks. Can we talk about the winning if the stock goes down next week? Yeah. We're gonna go to Rodrigo. We're gonna do each one. We're gonna buy a put, buy a call, buy a put,